the resource person, lecturer. So therefore, I face very hard to find appropriate course manual for this textbook. Anyhow, based on my experience, I have take some materials, especially from I took from materials from ACCA. Since you are in the beginning level, beginners, so I choose the very fundamental handouts. Like, this is the book I'm going to use for today's session, right? ACCA F2. So this is the book I use for this session, management accounting, so that it may help you. Before that, I introduce myself. I'm Dr. Riyath. I'm the senior lecturer at the Department of Accounting and Finance, Faculty of Management and Commerce at Southeastern University, Sri Lanka. And I'm the member of CMA Sri Lanka and the finalist of ACCA. And my area of specialization in finance, PhD in finance, master in finance. Okay, that information is sufficient about myself. Right. Here, when we look at the unit introduction, the goal of the strategy is to place organization to suitable position to support adequate resources. Right. The goal of strategy. Right. So if you are appointed as a manager for an organization, right, you have to have places many strategic. You have to take many strategic decisions. Right. You have to make strategic decisions. To take strategic decision, you need information. Right. Information is derived from the data. Right. Here, this is common. Right. Decision taken from information. That information coming from data. It's common. Anyhow, so we have to consider you are in the business organization. Right. Business organization point of view. The goal of the strategy is to place organization sustainable position supported by adequate resources. One of the key function of strategic manager, right? You are not just a manager, you are the strategic manager. So the manager is different from strategic manager. Planning and strategic planning. You might study a subject called strategic planning, SWOT analysis, environmental analysis. Have you studied SWOT and environmental studies? Have you studied?
Yes, sir.
Have you? Have you studied strategic management and SWOT analysis, environmental analysis? Have you studied?
Yes.
Okay, that's fine. That's good for you. So strategic managers to make long-term decision, right? Not a short-term decision, right? Long-term decision, 5 to 10 years plan that will contribute toward achievement of organization strategic objective. Achievement of organization strategic objective, right? So strategic manager rely both on quantitative and qualitative management information. So here the important term, management information system, management information. So the management information is different from just information management system. Here we are focusing on management information. So we will discuss about MIS, management information system. So this MIS may call as the different term, CRM, customer relationship management, ERP, enterprise resource management system, and there are softwares called SaaS, right? And there are so many things to ensure that decisions are take robust and take account of potential benefit and risk to the organization, right? This MIS, the management system, will help the organization to achieve their organization objective. Meanwhile, that information helps to reduce the risk of the organization. Strategic makers, right? Strategic makers will have acquired skills and knowledge that will be linked to the organization function, right? In the organization, there are different functions, right? Function mainly. So this is the organization. Organization at the top maybe CEO. Under that board of directors. This board of directors consists of many divisions, like um, uh, director, operations. Operations mean what? Say it is a manufacturing or garment organization, garments factory. So there's a manager for operating that facilities, machines, the factory, and director for marketing, and director for finance and accounting, and director human resource and development. So there are many branches. Under that there are many branches. So here now in this question, can you see my EndNote, this program? Can you see my organizational hierarchy? Okay,
Yes.
that's fine. Right. Now, according to this subject, the view, you should be here, right? You are in this position, right? You have to see these things, right? I got you. So you should understand the information. What are the information coming from this unit, director operation, right? So whatever the information provided by the director operation, you able to understand, and whatever the information coming from the management side, that also understandable to you. And also here the director finance, director HR. So you should have a holistic view, holistic knowledge, because from the organization data coming from different units. Therefore, you have to have a skill and capability to understand what the meaning, what are the insights of the units, the information, the data. That's why you have to study HR, marketing, right, operation, finance, everything, right? So you are the board of members. You are the one of the board of members. In the board of in the board, there are different people will participate in the meeting, and they are expressing their own views. So that views are data, and you have to process them as information. You have to, based on that information, you have to take appropriate decision. So that is the objective of this subject, right? Here the strategic decision makers will have an acquired skills and knowledge that will be linked to organizational function. So organizational function here, HR, marketing, accounting, finance, and operations, right? So these are the function of the organization. It will give you information. A team of strategic manager, as I mentioned, you are the member of the board of director. Therefore, could include specialists in such as finance, marketing, HR, and digital technology, right? It's a plus digital technology. So there are IT department, IT division. Strategic leaders will need to understand, interpret, and make use of financial data and other information, whatever their specialized skills and knowledge area. So as I told you earlier, right? So the operational director, operational management will give information regarding how much production has done, what are the material used, what are the cost of the material, and how many units we are having how many labors in the organization, what's the overtime and holiday strikes, right? Employee strike, that sort of information, right? Coming from the supervisory manager. In the marketing manager side, what are the orders? Are there any possibilities of making export? Are there any competition in the market? Right? That kind of information will arise from this marketing department. In the finance department, so here what's the cost of goods, how much profit, uh, investor relation, and how much tax has been paid, how much employee expenditure, how much salary expenses, how much cash in bank, so such kind of information. HR director, so how many right employees here, what are the promotion path, how to handle employee discriminations, employee harassments. So there are a lot of things, recruitment and everything, right? So all different information come to the board. So as you are the member of that board, you are able to understand the things. So when you look at this information, right? So some are financial information, some are non-financial information, some are qualitative information, some are quantitative information, right? This unit especially focusing on this. What is that? Financial information. How much sales, how much cost, how much sales expenditure, how much admin expenditure, how much interest expenditure, how much tax, how much salary payable, how much right, how much amount of money we have. So that kind of financial data. It's mean uh, the data expressed in rupees, right? Rupees or in other monetary value. Monetary value. So that is called what? Financial data, right? This unit, this unit 8, especially focusing on unit 8. Right here, the make use of financial data, right? And other information. Right. Financial data is a processed as part of an organization's management information system, right? It's a part of MIS. As I told you earlier, yeah, MIS may named in different views, but MIS it accumulate data from different functions of the organization. Strategic managers need to be able to apply financial technique. The financial strategic manager, right? Sometime you may think about, so I am HR specialist. Why do I want to study this kind of financial stuffs? So why I want to worry about what is the ROI, how much profit, how much tax expenses, how much interest expenses. So why do I want to know that? Right? No, that's true. That's not a reasonable question. So you are the member of the board of directors in the future. So you should be able to handle, you should be able to understand and process what the meaning, what are the insight of such uh, views of other managers. So that as a strategic manager, right? If you're just manager, if you just HR manager, you don't want to worry about what other functional data, how much sales, how much marketing, how much. No, we don't want. But if you are a strategy manager, right, you have to grab information from 360-degree view, right? So you will get information from different sources. From that sources, you able to might be able to process the data and take a correct decision at appropriate time. Strategic managers need to be able to apply financial technique, right? Financial technique. The organization performance are normally expressed in the form of reports like, forecast budget, right? Forecast budget, and break-even point, how many units we have to make sales to make the organization survival, right? And know how much we can give as employees bonus, and so this kind of information, this kind of decision you can take based on some analysis. For example, right here, budget. So if you are HR manager, right, HR manager, you may need, you may submit a, a budget, like, so how many employees from the level one, how many employees? So 1 to 2 years, 2 to 5 years, 5 to 10 years, like that. And from the basic level, how many employees? Say 50 employees, 70 employees, and 25 employees. And after 1 year, how many of them will be recruited, and how many of them will be promoted? Then when they promoted, how much salary increment they need? For that, how much amount of money we need? So that kind of information you have to forward to the finance department, finance division. The finance division will prepare the budget, right? The budget for the next 5 to 10 years, employee salaries, employee and other bonus salaries. And marketing department, right? The marketing department will submit a budget, right? So in which region, which product, uh, how many unit of sales, how much each unit selling price. From that, how much they can earn as a sales revenue. Then, right? So the marketing department will provide that income to the organization. Other way, in other functions like HR and operations, they are always spending money. Right? The marketing department will give money to the organization. That money will be used to other operation department and HR and other functions to spend. So that, to take a holistic view, as a strategy manager, you have to grab all the information. You have to get all the information and take appropriate decision. Say, for example, HR manager emphasize that, right? We have to recruit 50 employees. We have to recruit 50 employees as HR point of view. And marketing, right? Marketing manager says, sales, marketing manager says, so we are facing a lot of competition in the market. We are facing very hard to sell our product, right? There are new competitors entering the market. So in these instances, how we are going to take decision? So HR manager give a proposal. There are 50 vacancies with 50 employees has recruited, but marketing manager says, no, it's very hard to survive in the market because of the new competition. So that at these instances, how we are going to take decision, right? So this is very important as a strategic manager. That's why, right, when you study the finance accounting, you may get a holistic knowledge on this, right? Is it clear? Is it clear? So you can stop me anytime. So I'm very happy to answer your questions. So if you are not, so if you have any gray areas, please stop me and clarify your questions. And that I won't make this session more interactive. Otherwise, people may feel boring and sleepy, right? So please, the first 1-2 sessions, right, we have to talk about much on the theories, and the rest of the sessions, right, will be with calculation. We will have, right, we are engaged in calculation, so that we have to put our foundation is very strong. So right, this foundation could be more on theories, right? So clear? Is it clear? Insaf, are you there?
Yes, sir.
Okay. Right, now you can understand what the importance of MIS. Importance of MIS. MIS consists of the data. Right, MIS. is the place it store all the data sets, right? It store all the data. It store HR data, marketing data, right? Operational data and IT data and everything, right? So all of them are in their MIS. So normally MIS admin, the people who are the people manage this MIS, mostly accountants, accounting or finance department handle this MIS data. So right, strategy managers need to able to apply financial techniques and tools to analyze the organization's management information and take firm decisions, right, for different organizational reasons, right? Every time, every day, right? In the meeting, in the board of directors meeting, there are a lot of issues arise day by day. For that, you have to know, right? You should apply different decision-making tools and techniques. Right? How many of you have studied about break-even point, BEP analysis? Have you heard about break-even point analysis? Anybody else? Break-even point. How many of you studied break-even point? Break-even point. Have you heard about break-even point? Jihani, have you heard about break-even point?
Good morning, sir. Yes, sir.
Yeah. So can you tell me so what's the purpose of break-even point?
I actually can't remember exactly. Like 1 year ago, I studied that in SEMA.
Okay. Right. So normally the purpose of the break-even point is that it's a one of the tools in management accounting to decide what is the minimum target sales. Target sales where the company can survive, no profit, no loss, right? To ensure the company's survival, companies at least have to make a certain amount of sales. So to find what is the unit, what is the amount of sales, that technique has been used. It's very powerful tool, but when you study in A level, advanced level, or other higher national diploma and degree, so people just give. So this is break-even point. This is a chart. So this is a margin of safety. So this is the point, right? So I have interview with one of the chairman, right? Chairman of one corporate company. He has shared a lot of experience about this break-even point. He took 3 hours lecture on break-even point, not a theory, right? Not a theory. He took 3 hours lecture on how he convert the loss-making company into profit-making company. Actually, he's an engineer. He has no background in accounting or finance or HR, right? He has no background in management, but when he tell about the history of that company, the owner of the company always looking for a loan for what? To pay salary to the employees, because the company's sales is not sufficient. Company production or sales is not sufficient to pay to their employees. His routine work is to find loans to pay salary. Once he appointed as a manager of such company, first he studied why the companies always why what the reason, what the root cause of not making sufficient amount of money sales. He did an analysis, and finally he found a technique called break-even point chart, break-even point technique. He used break-even point technique. He established this is the sales target. If we achieve this sales target, then only the company's survival has been ensured. After that, he made a plan how to achieve this amount of sales to achieve break-even point. Within 6 months, he convert the loss-making company into profit-making company, right? So that much powerful tool, the break-even point analysis is. It's not a simple tool, but we are studying. So it's a small tool. Likewise, budget, NPV. Do you know that NPV analysis? NPV, Imran, do you know the NPV analysis?
No.
No. Right. Insaf, do you know NPV, net present value?
No, sir. No idea.
You might know, but so you may fear that I may ask any questions. Right.
Seriously, no idea.
It's okay. Right. So these are the tools and techniques available. You might study it, but you don't know how much the powerful of these tools. Okay. So this unit focus on financial data. All right. So financial data and managing information that strategy managers use when making financial decision. Right. There are financial decision. There are 4 financial decisions. Right. There are 4 financial decisions. I can explain in brief. Do you know balance sheet? Have you heard about statement of financial position? Balance sheet.
Yes.
You know that balance sheet? Yes or no?
Yes.
Yes.
Yes. Yeah. So what you can see the balance sheet, right? There are 4 quadrants. The balance sheet there will be 4 quadrants. Here liabilities, equities, and liabilities. Here assets. Here the long run and the short run. Right. Here what do you see? What do you see here? Equity capital and long-term loan. Here what do you see? Property, plant and equipment and long-term assets. Here you can see the short-term liabilities, here short-term assets, isn't it? So you might study the balance sheet in different way, right? In different way. You just equities and liabilities and assets. But now I divide, right? I present this balance sheet in different way, right? So there are, as I told you, there are financial decisions. Financial decisions. So when you look at the title of the balance sheet, so normally how does they express, how do they put the title of the balance sheet? For example, ABC company, ABC Limited, ABC Limited, and for the period 31st December 2024. So how could be the title of this title of the balance sheet? Normally, you might study it in accounting in A level. Normally, how to put the title? How to put the title? Balance sheet. Mihiri, how to put title for the balance sheet? So people normally put statement of finance.
It's balance
Yeah.
sheet as at 31st December 2024.
Right, right. Very good. the term asset. So when you put the title for income statement or profit loss account, how would be the sentence, the title? How would be the title? ABC company, no, profit loss account or statement of financial performance for ABC Limited for the period ended, no, for the period or for the period ended. You may use the term ended on. For the balance sheet, you use asset 31st March or 31st December 2024. But for the income statement, you may use year ended, right? Year ended on 31st March or December 2024. So I will tell you the meaning. So why they put like this, right? My focus here on the financial decision, right? Financial decision, right? Here, you look at this quadrant. So in finance, there are 4 decisions. One is financing decision. Financing decision. Second, which is investment decision. Investment decision. Fourth, the third, working capital decision. And so in between here, you can find dividend decision. Dividend decision. Right, you can hear. What do you mean by financing decision? Financing decision. So when you look at in the balance sheet, this quadrant represents financing decision. What do you mean by financing decision? Actually, what do you see here in the balance sheet? What do you see? What are the items we can see in this quadrant? What items we can see? The basic. Delika, what you can see in this quadrant? Ownership capital, right? Owner's capital. You can see owner's capital and owner's capital plus what? Plus long-term liability debt. Financing mean for an organization to establish an organization, they need capital. And there are 2 ways of raising capital. One is own fund. Second one is external fund, that is debt, right? So they have to decide whenever they need money, they have to decide where they are going to get money, where they are going to raise capital. So that is called what? Financing decision. Financing, right? Is it clear? Financing decision means right? Financing decision. Finance decision. There are 2 options. One is internal fund, internal funding, or external funding. External funding. So internal funding normally is considered own fund, and external funding is called what? The loan or debt, right? To start a new business, you need what? You need money. So that money is taken from by own fund or external fund. If it is own fund, that's called equity. It's called equity, and if it's external fund, it's called debt, right? So there will be a ratio. Some people decide 50% on money, 50% debt. Some people 30% equity, 70% debt. So this is called what? Financing decision. Financing decision, right? So is it serious decision or it's an ad hoc decision? What do you think? So have you get a clear idea what is financing decision? Have you get a clear idea about what is financing decision?
Yes, sir.
Yeah. So is it ad hoc decision or well-planned decision? Is financing decision for a company?
I
It's a
think
very
it's a
simple.
planned decision.
What's that? I couldn't hear.
Planned decision.
Planned decision. Right. Planned decision. Why? You might study about capital structure, right? Capital structure, right? Capital structure, right? Even though, right? So there are two types of risk. There are two types of risk. One is operation risk, operational risk, and is financial risk. Right. To explain this, I may ask one or two questions, basic questions. Right. So there are business organization. They are running super, right? So they are growing very fast. They're having right huge sales, huge sales, huge sales. But in 2 to 3 years, or 2 to 5 years, the company may be closed down. So what could be the reason? Can you tell what could be the reason? Even though company has huge sales, right, huge growth, but in 2 to 5 years, the company has closed down. What is the reason? More possible reason is what?
Proper financial management.
Yeah, proper finance. Can you tell me some? Right, it's a surface level, no? So
That means
based on your experience, yeah.
They maybe not focusing on expenses. They made a lot of extreme expenses and unwanted areas. That means without any ROI.
Right. The thing is, right? No, if you have huge sales and growing market, mean the daily expenses, routine expenses is not a matter for them because they are pump cash. They pump through sales. They can pump sufficient money to run the business. ROI. So those are doesn't matter for them. The actual thing is, you see, this is called financial risk. So I let you explain the operational risk. Operational risk mean when they do business, the ground, that's the market. In the market, the competitors, technology changes, government interferences, unwanted taxes. So this kind of things make the company right? Challengeable. It questions the survival of the organization. So that is operational risk. Say when you are going to introduce a product in the market, soon after a new competitor entered the market and challenged your sales. When you open a new hardware shop in that area, you found that there's no hardware in that area. Now you have decided to open a new hardware, right? In one, right? You make a lot of sales, and people observe, other people observe, right? Hardware is a good business. Then other people also copy your strategy and start a new business. So now you may face challenges of selling your product, or competitor, or government regulation. So someone come and ask you to close down the shop, right? So someone come and ask you to give some sort of money, right? So this kind of things are operational risk. But in this case, right, in the scenario I gave you, it has no any operational risk, no competitor, right? Your product has a lot of demand, you are selling your product, it pump cash. Despite why company closed down? The reason is financial risk. Financial risk coming from, root cause of financial risk is financing decision. Financing decision. So finance decision say the company owner get the loan at the capital, when the capital is 10% on capital, right? On capital, 90% debt. Sometime you see, the huge amount of profit, huge amount of sales has been used to settle their loan and their principal, the repayment, debt repayment and interest. The huge sales, this all sales has to be used to settle this debt. It's okay, right? It's okay, right? It's okay. The sales is going up and up and up. This time, the owner doesn't care about the payment of interest and the repayment of principal of the loan. He doesn't care because it pump a lot of cash, no, right? There are some circumstance comes, if he experience very slow down of sales, if they close the shop for 2-3 days or 1 to 2 weeks, there will be a small drop in their sales. Then he faced difficulties. He faced huge difficulties to pay interest. Whether you make profit or not, you have to pay interest to the bank. So that then you face a lot of difficulties to pay the money, and you have to close down the shop and go. So this is the root cause of financial risk, right? Even the small sales, right? So if you want to get more explanation, I can give one scenario, right? One person getting loan of 10 million, 100 million loan, 100 million loan, and here his, sorry, did you get my point here? What is operation risk, what is finance risk? Now you get the importance of uh, importance of no, the mix, capital mix. How much amount of capital, own capital, debt capital, how much amount of uh, equity capital or debt capital has to be included in the financial structure. So that is financing risk. Did you got the basic idea of what is operation risk and finance risk? Is it clear? Or otherwise, I will give you a scenario. Or otherwise, I will give you a small scenario. Is it clear? Or do you want a scenario explanation with small calculations? Can you hear me?
Please give another scenario.
Please
Okay.
give another scenario, sir. Yeah.
Okay. I will. Can you see my Excel sheet?
Yes, sir.
Okay.
Yeah.
Right. For business, they need 100 million capital. Right. Capital requirement. Say 100 million. Out of this equity, right? Equity means owner capital, say 10%, and the debt capital, say 90%, and the loan interest it could be 20% interest. 20% interest. Right. Let's see in this scenario the sales for the period. You put the sales here. Sales. Sales here. This time the sales 50,000 or 500,000 sales. 100,000 sales and 200,000 sales. For that period. Right. Then operational expenses may be operational expenses for that period, say 400,000. Operating expenses, 400,000. Yeah. Operating 400,000 here, 800,000. Here, 16,000. Right. How much gross profit? Gross profit could be this value minus operational expenses. So this is the amount. Likewise, same amount. Then, right? Then we'll see how much interest here. So this scenario, see this one. Interest. How much interest he has to pay? Interest. How much interest he has to pay? How much total amount of capital? 100 million, and the interest 20%. So this is too much now. So So I will make everything equal. Right. I will make everything equal. I will change only the debt and equity. So this company, right? This company, 90% debt and 10% equity. No. So here, how much debt and equity here? 1 million capital requirement, of which 90% debt. How much 90% debt? Or let's start from 50-50. 50% debt, 50% equity. Then here, 10%, sorry, 80% debt and 20% equity. Sorry, equity like this. 80% equity, 20% debt. Here, 20%, 20% equity and 80% debt. 80% debt, right? So here, how much debt could be? So capital requirement is 1 million. If 50% debt, 50% equity, how much loan he should get for this business? How much? 100% into 1 million into debt, 50%, no? Right. How much loan? 500,000. So interest for this loan is 20%. How much interest expenses? 100,000. This time, how much profit? How much profit? Gross profit minus interest. So no profit, no loss, right? No profit, no loss. Look at here. Look at here. How much loan? 100,000 into only 20% loan. 20% loan. So therefore, loan will be only how much? 200,000. Then how much interest has to pay for this 200,000? So they have to pay only 20% interest. Then how much interest expenses? 40. Then how much profit? 60,000. Right? Same here. Right? Here equity 20%, debt 80%, loan 80%. Then how much loan? Out of 1 million, 80%. 80% will be the debt. So therefore, he should get loan for how much? 800,000. Then how much interest they has to pay for this 800,000? Annual interest rate is say 20%. 20%. How much? 160. Then see how much profit. You see here, the same business, right? Same business scenario, right? Same scenario, but in this case, for A, B, and C. A, B, C. There are three scenarios. But you know, all these three companies, say company A, company B, company C, sales are equal, right? Company A sales 50, B 50, and also operation expense also same. Gross profit also same for these three companies. But these three companies are having different profit and loss. A company, no profit, no loss. B company, 60,000 profit. C company, loss. Why do company C make loss? Even though all these three companies having equal sales and expenditures. What could be the reason? What is the reason?
Their debt is higher than the rest.
Yes, here. Because of the interest. Because of interest. Right? Because of the interest. Keeping loan is good or bad for the company? Keeping loan good or bad for a company? For organization? So by looking at this scenario, it seems bad. It seems bad. Okay. So when you convert this, say, who is getting high profit? Who is getting high profit? You know, return on equity, right?
Company.
ROE. ROE, return on equity. Right, return on equity. You know what? Do you know what do you mean by ROE? Do you know ROE? Return on equity, right? Look at here. Return this amount. Equity, how much? Equity. Equity. So I would one row again. Equity. Equity. How much equity here? So this is debt. No, this is debt. So this is equity. Likewise, this is equity. This is equity. Is it clear? This is debt. This is equity. Right? This is debt. And this is equity. Clear? Is it clear?
Yes.
Okay. Now ROE equity. I want to show how much return on equity. Here return this amount, equity this amount, 9%. Likewise, you see how much profitability. $900%, 570, 2020. So just ROE is 9 here. ROE is 9 when 50-50 debt and equity balance. He maintain balance. Here, when he use more debt, sorry, less debt, more equity, then how much return on investment? Return on equity, how much? How much profit per equity? Or we can say for 1 rupees investment, how much return? 6 rupees here. Here for 1 rupees equity ownership capital, how much profit for company A? 9 rupees, isn't it? 9 rupees, but they are having balance, half debt, half equity. And here, what is it? For 1 rupees investment, he earn only 6 rupees as a profit. Here, for 1 rupees equity ownership capital, he earn 22 rupees as a profit. Then can you tell me, having debt within the organization, so good or bad? Here more profit, more return, isn't it? Sorry, more debt, more return. Do you agree with me? Or is it confusing? You just look at the scenario. I zoom out. Did you get any point here? So what is my question? Having debt in the working capital is good or bad? Getting loan is good or bad for the business?
It's bad.
Why is bad? Here you get 80% loan, right? 80% loan, but you get for 1 rupees investment, you can get 22 rupees. Here, small amount of debt, big amount of equity, but you get very small 6 rupees for your return profit per 1 rupees investment equity. Here 50-50, half equity, half debt. So in that case, you get only 9 rupees. Then by comparing these three scenarios, having debt, having loan is good or bad?
In that case, it's good here.
Is good here. But you see, during the growth phases, right, if there is no risk, if there is no operational risk, then it's good. But you know, so this company, I reduce 1 0 for each. See what happened.
Depend on the sale, it's
Yeah, so yeah, sometimes it's a risky. It's a risky. It is risky. It is risky. You see, when we make it to only 200,000 sales, when sales go down, it's go other way around, isn't it? It goes other way around. It's extreme. So when you include loan into the organization, it's multiply. If it is good, if it is, if the business scenario, business environment is good, it will boost multiple times your profit. If the scenario goes down, if you include more debt in their company, it will make worse. Right? It's a multiplier, right? It's a booster, plus or minus. It's a booster. In the positive side, it's plus, boost by plus value. If it's negative, it boost. It's mean downgraded by the, right, and the organization loss. So it's no speed. If you are good, if you go in a good direction, good condition, right, your business profit will multiply 1,000 times or 10 times, 100 times. If your business go down, then your loss will be multiplied, right? So that's why I ask you, this is a just ad hoc decision or well-planned decision, financial decision. So can you now tell me, this is a just ad hoc decision or well-planned decision of having how much amount of debt should keep within the organization? It's well planned.
Should be well planned.
yeah.
It's a well planned. It's a well planned. So there are a lot of theories to decide how much amount of debt has to be included. So there are three theories. It's called net income approach, number 2 income approach, number 3 Miller and Modigliani, Miller and Modigliani, Sometimes we call MM theory. MM theory. And for it's called pecking order theory. Pecking order theory. So there are theories to decide what is the optimum level of debt to be included in the capital structure. Some theory says 20% good, some theory 30%, some of them are saying 80% good, some of theory says 100% debt is good sometimes. Right? But it is based on some other assumptions, but we can't blindly accept these theories. So we have to see the company's circumstances, so that in this scenario we put different values. Here we put 200,000, right? Now 500,000, and we put 5 million. Then it changes. So it is called what? Different scenarios. So this making different scenario is called what? It's called budgeting, right? Simulation, budgeting. So this is budgeting. Budgeting. We may forecast sales 200,000. We can forecast sales 500,000. We can sales forecast 50 million, right? 5 million. So we can have different scenarios. Sometimes called scenario planning, or sometimes called budgeting, budget forecasting. So these are the financial tools. When you look at your syllabus, you can find this. You see, these decisions will be about planning and allocation of resources based on financial models and financial statement prepared and presented by the organization management accountant and financial accountant. So when you see the syllabus, you can see the items. See, analyze function of the organizational budget and systematic analyze relationship between budget planning and operational planning, a lot of things. And investigate the factors impact on financial decision, critically analyze short-term financial decision and the long-term financial decision. Here, long-term financial decision. And you have to analyze the financial statements, and you have to analyze the financial performance, and many more, right? So the financial planning is not a simple task. HR may propose one proposal that may entirely conflict with the marketing proposals, and finance department may invite them, and they should compromise, right? They should compromise. So but whenever they need loan, just go to the bank and get the loan. It's not an ideal decision. Whether they are going for the loan or not, whether we accept HR department proposal or reject the marketing department proposal, is entirely depend on the financial analysis, right? Financial analysis. So that's why this module is very important, right? This module is very important. Successful completion of this unit will enable learners to analyze these financial models. In this Excel sheet, it's one of the financial model, right? This is financial model. Likewise, break-even point analysis, break-even point is also one of the financial model, break-even point. And the NPV, this is also one of the financing model. Budgeting and variance analysis, and you may study about Porter's 5 forces model, and so there are a lot of tools you might study it. Some tools are especially for that field, say Porter's 5 forces model, that belongs to that overall strategic management model. Break-even point analysis entirely for marketing and finance team. NPV entirely for the project management. It's mean new establishment of new branches or establishment of new facilities, factories. Right? The variance and budget, it's entirely for whole organization. So most of the tools are related to finance. So whenever you talk about the rupee value or monetary value, those tools coming under the financial models, finance, right? This is very important. And the financial statement to assess and evaluate the organizational performance. You may have balance sheet, profit loss account, says statement of financial position, statement of financial performance, cash flow statements, all of these things you should write, or you should able to understand and explain. So whenever somebody submitted you balance sheet or income statement or cash flow statement or statement of equities, annual report, you be able to understand what is the implicit meaning. You should know, evaluate the performance of the company, a current state of the company's financial strength, company's financial weaknesses. Are the company able to survive in the long term or the short term? Are there any possibilities of collapse, bankruptcy? So this kind of ability you should have. So that's why it is important to study this module and determine the reason for underperformance. Why do the company underperformance, right? Even though the company make a lot of profit, why do the company making loss, facing loss? And challenges, what are the financial challenges it may have? The company has taken a big amount of loan from the bank. Then why do company unable to settle that loan? And revenue, to evaluate the revenue, to analyze the cost, to analyze the liquidity, working capital, financial return like ROE, ROI, ROE, just we discussed, and ROI, return on investment, efficiency, and overall profitability like EPS, DPS, right? Earning per share, dividend per share, all of these things you should be able to understand. Achievement of this target will enable organization to improve its position in a competitive market. Right. Now, after complete this course unit, you may have an opportunity to join as a manager in any PLC or large companies. Then you should have such kind of capabilities. You should face a big competition in the market. If you have a thorough knowledge on this business strategy, we can make your company survive. Otherwise, companies also, the survival of the company is questionable, then your job also questionable. Right. This unit does not require any prior knowledge of financial or management accounting, so it is no need to study on financial management accounting, but learners should be confident in the application of numerical skills, right? So you should have a better ability to handle numbers, mathematical, and data analysis. It is not like business intelligence. Just you should be able to do some calculations like ratio analysis, percentage calculations, and break-even NPV, like that, to assist in the management decision making and formulating business strategies. So these are the things you should have, right? To pass, so let us look at the learning outcome of an assessment criteria. To pass this unit, the learners need to meet all learning outcomes for the unit. The assessment criteria determine the standard required to achieve the unit. First one, right, learning outcome. Understand the contribution of the finance function to strategic decision. Here we get to assessment in the assessment. Analyze the relationship between cost accounting, management accounting, and financial accounting. critically analyze the application of financial, right? Financial accounting, cost accounting, and management accounting. You see here, I explained you. So there are different accounting, financial accounting, cost accounting, and management accounting. You should know each of these, and you're able to differentiate uh, of differentiate among them. Critically analyze the application of financial cost and management accounting in an organizational context, so that you should know what is financial accounting, what are the scope, what is cost accounting, what the purpose, and what is management accounting, how it helps to the organization management, what decision making. And then critically evaluate the contribution of management information, right? So we are talking about information management, information at MIS to the organization financial decision making, right? So shall we go for a break for 10 minutes? Shall we go for a break?
Okay, sir.
Okay. Shall we start by 10:30? Is it fine? 10:30?
Okay, fine.
Okay,
Okay.
fine, sir.
Okay.
Okay, fine.
Right, shall we continue? Shall we? Are you there?
Yes, sir.
Okay. Right. Yes. Then I stop here. I'll just explain what is financial decision. Right. Now I will explain you what is investment decision. Investment, a company has already decided from which sources they are going to get money. Say they may decided to having money, right? 50% equity and balance 50% from debt, right? So the board of directors has decided. So this is the ideal capital structure. Then the company has to decide. So there are investment project one, project 2. So there are different projects. Project means, say for example, so they are involving in export of garments, one business project, and project 2 is retailing of fruits. Project 3 could be establishing new supermarket, right? So there are different options, right? They have decided, they have money, and where they are going to invest. So it is profitable on investing money on project 1, or profitable in project 2, profitable on project 3. So different project give you a different profitability and risk, right? Each investment having the combination of risk and return. Some investment give you a big amount of profit, but also come with a big amount of risk. Some profit, right? Some investment give you a small amount of profit, but small risk, right? So there are different combinations, of which the organization should decide where they are going to invest that money, right? Investment. So here, in simple term, financing decision mean financing decision simply where get money. Investment decision, right? Investment decision, in other hand, investment decision, it's simply where invest that money, where invest the capital or money. So that's investment decision, right? So so that is this one, investment decision, on which assets they are going to invest, right? On which asset they are going to invest their money, or which project, that kind of things. And working capital decision, how much amount of money, right? How much inventory they have to hold, inventory, how much stocks, and how many days we can give to settle our customers. Normally, the company sells their inventories on credit terms. No, most of the sales are on credit term. And how many days, whether 30 days or 60 days or 90 days credit, or right, and even a short-term loan. Our company also purchase items from suppliers on credit terms. When we are going to settle it, so within 10 days or cash purchase, or settle within 10 days, 15 days, 1 month, 60 month, right? And so that kind of decisions. And also when there are need for sudden cash needs, whether they go for a bank OD, or they are selling some of their marketable instrument, like the company may have shares in the Colombo Stock Exchange. So if they need money suddenly, either they can choose to sell the shares and make money, or just approach the bank and get the bank overdraft, bank OD. So that kind of decisions coming under uh, working capital decision, right? Working capital decision. And dividend decision simply this. So company make profit, no? Company make profit. This profit belongs to whom? Company make profit. This profit belongs to whom? Company make profit, no? So this profit belongs to whom? Profit belongs to whom? Company make profit. This profit, who are the owners of the profit? Who? Mihiri, are you there? This profit belongs to whom? Company make profit. This profit belongs to whom? Dilika, are you there? Dilika, Imran, are you there? Can you hear me?
Owners and the shareholders.
Right, right. Owners and the shareholders. Right. Then how they are getting that profit? What is the way of getting that profit? So shareholders are outside. Shareholders are outside of the organization, and board of directors are running the company. Then how they are going to get that profit? What's the mechanism?
So interim dividend sharing and all.
Yeah, who decide? Who decide dividend to be paid?
Board of directors.
Actually, the shareholders at the general meeting, right? At the general meeting, shareholders decide, right? Say, how, right? Does all profit distribute as a dividend, or keep that money inside of the organization for the purpose of investing that profit for the future proposals, future investment, which is ideal? Distribute the profit among the shareholders, or keep that money within the organization for the purpose of reinvestment? What is the best option? What's the best option would be?
Balancing both.
Right, it depends, no? It's depends in the AGM, they decide. So there will be a problem. There's a decision has to take, right? How much amount of money, how much should keep within the organization, how much should be distributed, how much distributed. Say for example, 50-50, as you said, as Imran said, 50% inside, balance 50% distributed as a profit. Give me a minute. Sorry. How much money has to be distributed as a profit, as a dividend to the shareholders? How much amount of money should be keep with the organization? So it's depend on it's depend on the circumstances. For example, shareholders invest all of their money to the company, and they relies, but the shareholders relies on the dividends, right? The dividend. So that in that case, in that instances, if the management decided to keep all the money inside, then the shareholders will be disappointed and he has no income. So one way is he has to sell their shares, right? That is not ideal solution. If they keep all the money, right? If in other way, if the company decides to give all the money amount, right, all the money as a dividend to the shareholders, there are opportunities. There are some opportunities within the organization for reinvestment, good business opportunities. They need money. So in that instances, how they are going to handle this? So of all the money has been distributed among the shareholders, but no money in their hand. So that the company has to keep a certain amount of money within the organization and has to distribute a certain amount of money to the shareholders. So what is the optimum level? So it's depends, right? When the company has a company in the growth stage, the company need a big amount of money. So that time, declaring the profit as a dividend is not ideal solution. So they keep the money rather than, right, once they, right, if they have a good growth opportunities, all the profit has been shared to the dividend. For the investment, they have to approach a bank. It's not a good idea. So that, so it's not an ad hoc basis, the decision. So this decision has to be well planned. So there are 4 decisions. What are the decisions? Can you tell me? Can you list out the decisions? And Munasinghe, can you tell me the 4 decisions of the financial management? What are the decisions we have discussed? Just list them. Munasinghe, are you there? Munasinghe? Stalin? Stalin, are you there?
Yes,
Mhm.
sir.
Okay, can you list out the 4 decisions? Number 1, financing decision. So simply where the company is going to take money, financing decision. Second, investment decision, how the company is going to invest that money. And the second one, working capital decision, right? So what are the short-term financing mix? And fourth decision, dividend decision, how much amount of money should be distributed among the shareholders and how much should keep within the organization. So these are the 4 financing decisions. Whatever you study in accounting, right? Whatever you study in accounting and finance, is all about coming under these 4 categories, right? Right. Now we move to this handout. So here in your learning outcome, we have to talk about much about management information system, right? In management information system, we have to talk about the data, and information, how they are going to take decisions, right? So this today's session is in line with for assessment, right? Assessment. So we have to have a clear idea about, understand contribution of the finance function to the strategic management. So strategic finance function, right? Finance function. These 4 financial decision called finance function. Finance function. Here it's clearly mentioned, right? Understand. Yeah, this is understand the contribution of finance function. These 4 decision called as finance function. What are those? Financing decision, investment decision, and short-term decision, sometimes called working capital decision, and dividend decisions, right? Understand the contribution of the finance function to strategic decision making, right? So that will be tested in your assessment. And understand the strategic management decision process. You see here, strategic decision process. Understand the strategic decision process of the organization. So I will focus that as well. And understand the financial tools used by strategic manager in relation to financial decision making. At everywhere, right? Financial decision making. Understand the financial techniques applied to evaluate organization performance. So we are not discussed today this thing, but so I have discussed this thing, financial functions of the organization. I have discussed a little, and I will now, in the next half an hour, 1 hour, I will discuss the decision-making process of an organization. So the assessment approach, right? Suggested assessment approach, an assignment based on the learner's own organizations. You have to choose your own organization or good quality case study of an organization, right? So this A and B will be tested in this assessment. There will be a 2 assessment, right? So in this assessment, all learning outcomes A and B will be tested, right? This is A, understand the contribution of finance function the decisions to strategy management process, and understand the assessment 1 will cover A and B. Understand the strategic management process in the allocation of financial resources. Here we have to talk about budget and the relationship between the budget and budget planning process and budget controlling things. So that is the thing. So that I use this textbook, ACCA textbook, to get the basic ideas. Any doubt? Any questions? For information for managers. This is a chapter 1. Here we will talk about what is information and the planning, control, and decision making, and financial accounting, cost accounting, and management accounting, and presentation of information management. Right. So these four areas may be relevant to this outcome. Right. To understand the contribution of finance function. Right. Any questions? Any question, please? Any doubt? Any questions? Okay. So what is data? What is information? In your day-to-day life, you may use these terms. Data and information. What do you mean by data? What do you mean information? What's the difference? Any ideas from you? What is data? What is information? Hmm? Any idea? Imran, what is data? What is information? Hmm? Can you hear me?
Information made through datas.
Yes.
That means
So data mean the effect. Data mean effects. For example, sales, number of employees, and how many facilities, number of production, and qualification of the board of directors, name of the directors. These are the fact when the company has established, in which industry it has, and how much total the employees, how much total sales of the company. So these are the fact. Now, how we can convert this data into information, right? For example, from the sales, right? We take sales value, sales in the quarter one, sales in quarter two, sales in quarter three, and in quarter four. We don't have information data on the quarter four. So what you can do is you can forecast, right? This is a fact. This is the data on Q1, Q2, Q3. So based on this, the data, the trending, right? So you may observe that your sales grows like this. Then you can expect that this quarter as well, sales may be increase. Right now, when you look at the sales quarter before you process it, it is just data. Now you process the data, then you can say that the next quarter sales will be this amount. This is forecasted because the data actually will not help you to take any decision. When you convert the data and information, so that information will be useful for the decision. The processing of data, the processed output of the data is called information. Here, the data is a raw material for data processing. The data relate to the facts, events, or transaction, and so forth. For example, invoice, sales invoice, sales invoice of your company. There are millions or thousands of invoices in your company. So those are just the fact, what you buy, what you bought, from whom you have brought it, when you bought it, the value of the purchase or sales. So these are the data. Now you accumulate these invoices, right? And you record in a systematic way. After that, you summarize the thing, right? And then you may see the trend, the increasing or decreasing. So what are the, when you do the analysis, so on what area, on what product we make sales more, so which sales item having facing challenges, in what sales item we have to make a lot of promotion advertisements. So those kind of information you can take, and you can take decisions, right? So the basic level of information is data. The data, information is the data that has been processed in such a way to be meaningful to the person who received it. Information is anything that is communicated. You can't communicate just the data. You can take decision based on the processed data. When you process the data, when you process the data become information. By information, based on the information, you can take decision, right? Right. The qualities of good information. What are the qualities of good information? It should be relevant. It should be relevant information. So when I talk about your company sales, so I assume that you are a sales manager. I ask you about sales forecast of product A, sales forecast of product A. Then you have to present the relevant data for a particular company or particular product. What you do is, if you present another company data, or instead of A, you choose company C and product C. If you present that data or that information, so that information is irrelevant. That data, that information cannot be used for the decision making. So that is, the data should be relevant. Second one, completeness. Right? Completeness means the data you provided should be complete. So you can't provide the information about, so I'm guessing, I'm thinking, so if my memory is correct, so you can't say. So you should provide a complete data set. Some years available, some years, few years are not available. So there are blanks, or you with some fabricated data. No, the information, right? The information should be complete. The information, an information user should have all information, right? Should have all information he need to do his job properly. If he does not have a complete picture of the situation, he might well make a bad decision. For example, if you are a marketing manager, you are going to introduce a product in the market. Before you taking this decision, this idea, this proposal to the board of directors or discussion, you should provide all the information. What product, what is the cost, what is selling price, and what is the processing process, and what are the competitors, what are the products available in the market, so how the sales figures will be move in the market. So all such information you have to provide. Just rather than that, you just propose a product. When one of the director ask you how much the product, so are there any competitors, how many product in the market, how much processing cost, how much in the market price. So if somebody may ask this kind of question, if you say I think the market price, or I think there are competitors, if you say, your data is not complete, right? So this kind of data cannot be useful. Accuracy, if somebody, that you propose a product, if somebody asks you how much the cost of that product, how much the cost of the product, you cannot say I think the cost will be around 50 to 40 rupees. No, it's not accuracy. You have to say concretely, precisely, this is the cost, 40.35 cents. So in that way, you have to tell the information. Accuracy, information should obviously be accurate, because using incorrect information could have serious and damaging consequences. However, information should only be accurate enough for a purpose, and there is no need to go unnecessary detail for pointless accuracy. Some people give a lot of information, unwanted information, to prove them they are accuracy. That is not necessary, right? You have to provide what is required. You have to eliminate unwanted over information. Clarity, clear. So whatever the information you provide should be clear to the user. Clear, not ambiguous, not doubtful. So some people, so whenever ask question, do you like or not? Do you like or not? It's very hard to decide whether he is arguing yes or no, right? So no clear cut data. And the information must be clear to the user. If the user doesn't understand it is properly, he cannot use it properly. Lack of clarity is one of the cause of the breakdown in communication. It is therefore important to choose the most appropriate presentation medium or channel of the communication. Clarity, right? You should have provide the data very clearly, right? That's why you have to write business communication, and how to write the data, how to present your uh, ideas, your requirements, everything. Confident, right? When you give any data, you should have very confident enough, right? You should have confidence. You can't give the data with you have no confidence, right? Say I think so it's around, so you can't use that. Information must be trusted by the managers who are expected to use. Some people say lies, some people know over build up, right? Foolish the fact, right? That should not happen. Confident. Over build up is not a confident, right? Whenever you present the data, you have to have a confident. When you get confident, when the data is accuracy, when the data is accurate, when the data is relevant, then only you may have a confident. Otherwise, you might just, right, you just escape from the no confident. Some information has a certain specialty, especially operating information. For example, related to production process. Strategic information, especially relating to the environment, is uncertain. However, if the assumptions underlying it are clearly stated, this might enhance the confidence with which information is preserved. Right. Sometime, right, if a market manager, you submit a proposal to the board regarding the new product, someone can ask in the board meeting, what could be the competition? What if new market entrants, new competitor enter into the market? What will happen? So this time you may have no clear idea, but you have to present your idea with some of the assumptions, right? So what are the assumptions you make? That assumption should be clearly stated, right? We assume no only 2 or 3 competitors will enter, or there are chances based on the environmental analysis, there are chances of becoming 2-3 competitors. So that you have to clearly state what assumptions you made in communications. So this is the problem of many having. So people having highly technical knowledge, well expert, right? Well expert, but they are poor in communicating the ideas. So I had one experience. So I bring my student for one competition, right? He made a robot, right? It's 10 years back. Nowadays, very AI, everybody can make robots. But 10 years back, one student did small robots. That robot can control entire home electronic system. It's a very good idea. So I bring him to the competition. But the judges come to the place and ask them to explain about the project. But he has communication issue. He has no right. He was unable to express what the idea actually is. But that time I tried to interfere and I tried to explain the thing, but the judge said, so you can't. So the student should explain the thing. But he unfortunately he got failed. But it's a good project. Right? The thing is he can't communicate well. Even though if you have great ideas, if you are unable to communicate in a proper manner, right, then your idea will not be accepted. But what here in this subject, what the thing is, when you communicate your idea, you have to follow a proper channel. you have to maintain the protocol. You know, the organizational hierarchy, how you can communicate. Your head from the head of the department to the divisional head, and then right. So in that way, it will bring to the board of directors. So easy, you should not bypass the things. Always we have to maintain the protocol. So communication within any organization, individuals are given authority to do a certain task, right? You can't give advice to the top management, right? You directly go to the CEO office. The CEO, this is not a way of doing the things. So you have to do this matter in this way. So you can't, right? You have to have a certain limit, and they must be given the information they need to do that. So an office manager might be made responsible for control expenditure in his office, right? In that things you can't give advice to the manager. So this is how you have to make expenses. So this expenses you have to cut. No, if you are accounting manager, you have to do your task within your scope. You can give any suggestions. So you don't want to interfere any other matters. Volume. So you have to provide sufficient volume of the data, right? Sufficient volume, not excess data. And the data should be the timing. Timing mean, so whenever the data is required, at that time the data should be available, right? At that critical moment. So channel of communication. So this is actually is regarding the organizational hierarchy and the cost benefit. Always you have to do the cost benefit data. Some data are very costly, but the use of the benefit of the data is not much beneficial. Always we have to analyze the cost and benefit. Right. So why information is important, right? So this kind of things I can read. I can share this material with you. Right. Here, what type of information is needed? What type of information is needed? So we can divide the data into, right? We can divide the data into financial data and non-financial data. And some data is a combination of finance and non-financial data. Some data is purely financial in terms of rupees. In terms of rupees, normally in financial accounting, the data purely in rupees. Non-financial data, normally this kind of data is coming from the HR department. Employee promotion and employee harassment, employee recruitment, employee promotion, so that kind of things. So those are purely non-financial data. But most of the time, the data come with a combination of financial and non-financial data. Right. Now we look at financial and non-financial data example. Suppose that management of ABC company have decided to provide a canteen for the employees. So what are the financial information you can get it? Financial information required by the management might include canteen staff cost of subsidizing the meals, capital cost of heat, cost of lighting, and so on. You know, in this data, the financial information always come up with rupee value, rupees, or other financial term. You know, cost of staff, how much salary you have to pay. Do we have to pay all the overtime to the staff? And subsidizing. You know, in outside the lunch packet may be 1,000 rupees or 500 rupees. So inside, so to provide lunch to the employees, it should be provided on cost for the company. Happy to establish the canteen, how much company has to be spent. right? So, heat. So this is from the Europe, no. So we are using AC, air condition, but they are using heaters to heat the to warm the organizations. So always they are talking about the rupee value or monetary terms. So such information is called financial information. And non-financial information, right, include management commitment to the effect of employee morale, how people uh, behave. So how about the canteen facilities, right? How many chairs, how many tables, where the people can buy the product, and how they are bring the product within the canteen from our operating hours of the canteen, right? Number of meals served per day. So those kind of things are non-financial data. So those are not come up with the monetary value. ABC company could now combine financial and non-financial data, right? Always the report you can see that. So those data is a combination of financial and non-financial data. Right. So this is the important thing. Decision making, right? In here, decision making, financial strategic decision making. So you should know the process, how companies make decision, the process. So here, when we talk about the decision making, we cannot avoid planning and control. Planning and controlling. When you study the management side, you might study the plan, organizing, implementing, and controlling. So that's what we are not discussing here. So we are having in a different angle. So planning stage, and we implement the control. Is it control means simply when we implement the planned activity, what are the deviations? How to control the deviations than the expected results and the decision making. So planning for management is likely to be used for planning, controlling, decision making. The information for management is likely to use what? We talk about the data and information. So why do we need data? Why do we need such information? Why do we need? We need information for planning, for controlling, for decision making. An organization should never be surprised by development which occurs gradually over an extended period of time, because organizations should have implemented a planning process. Planning involves the following, right? Always plans start with establishing an objective, right? First, they have to decide the target. That's establishing objectives. Establishing objective 1, objective 2, objective 3. So there are certain objectives, right? From that certain objectives, they have to choose the best objective, best target, and then they have to develop appropriate strategies to achieving the objectives, right? So there are to achieve. So organization should have one objective, always one objective. That objective, once the objective has decided, the management should plan the possible strategies. What are the strategies? Selecting appropriate strategies. Strategies mean the ways, right? The ways of achieving those objectives. Planning, therefore forces management to think. Right? Planning is actually what thinking process. Think ahead systematically in both short term and long term. You may have short term plan and you may have long term plan. So all of those things are right, make you think, force you think. So what is objective management? So all these things you might study in the finance, not in strategic management or management subject. So we could just recall what you studied here. An objective is an aim or goal of an organization. Note that in practice, the term objectives, goals, and aims are often used interchangeably, right? Technically, the objectives, goals, and aims are different, but here we use them as interchangeably. A strategy is a possible course of action that might enable organization to achieve the objective, right? Objective, goal, aim is a target. Right? That's a target. That's a that is the destination, right? That's a destination. And the strategy mean the best way of achieving that objective. Company, right, always the company is making profit. Business organization, always they are working for making profit. And there are non-making profit organizations like charities and trust and government and the civil organizations. So they don't have profit-making motives. Right. In conclusion, the objective of organization might include one of the following. So profit maximization, all the companies always they try to maximize their profit, maximizing shareholders' value. They had always try to minimize the cost and maximize revenue, sales revenue, and increase market share. Always the companies having this kind of profit, this kind of motives. Strategy and organizational structure, right? There are two school of thoughts on linking between strategy and organizational structure. Structures follow the strategy and strategy follow the structure, right? You might study the organizational structure. The organizational structure is not an ad hoc thing. While they establishing the organization, they establish the organizational structure, right? There are two ways of developing organizational structure. One way is first they develop the strategy of how they are going to achieve the organizational goal in the long term. In that way, they have developed organizational structure, right? Organizational structure. That is one method. Second method, they already established a formal organizational structure, right? On the structure, and then they try to adapt their strategy to the organizational structure. So there are two things. Normally, strategic planning, called long-term strategic planning, they plan for the long term. Strategic planning is always referring the long-term plan, sometimes called corporate plan. Right? Long-term planning, also known as corporate planning. Long-term planning is also known as corporate planning, involve selecting appropriate strategies. As to prepare long-term plan to attain the objectives. Right? The strategic plan is long-term plan called strategic plan. Right. The long-term planning is a detailed, lengthy process. Right. The short-term plan. A long-term plan is a corporate plan. Right. And the short-term plans usually covering 1 year and related sections, so division, functional departments. So strategic plan is applicable for entire organization as whole. Strategic plan. The tactical plan or the short-term plan, it's relevant to a particular division or particular department or particular section or particular function, say HR planning. So that is for particular function, HR function, or the planning for a branch or planning for a different product. So that is what? That's the operational plan or tactical or short-term plan. Okay, this is what we need. Actually, this is the planning process. Right. Have you studied strategic planning process? Have you studied strategic planning process? Trishani, are you there? Dampure, Lianage, Trishani, are you there? Jihani, Udesika. Jihani, are you there?
Yes, sir.
Right, have you studied strategic planning?
Yes, we did in digital business management.
Okay, good. Yes. Then I think you studied SWOT analysis, environmental analysis. Am I right?
SWOT? No, I think. No.
Environmental analysis, pestle analysis.
As far as I can remember, no, sir.
Okay. Right. The planning process always it start from the assessing the environment, external environment, assessing the external environment, assessing the organization, assess the future, and assessing the expectations. Right. The assessment stage. Stage 1 is an assessment. External environment means sometimes we call pestle analysis. Pestle analysis. So what do you mean by pestle? Pestle mean what? P referring what? P is referring
Political?
very good. E
I think economic or
economic
environment.
Okay. Yes.
Social.
Social. T
Technology.
Technology. E economics. And L
Legal.
legal environment. So you studied, right? You study without this pestle, you couldn't study the strategic management, right? Assess the external environment. Yeah, assessing the organization, no, internal. So this is sometimes called microenvironment. So here, organizational resources, core competencies, organization strategies, staff, resources, right? Everything, right? So that is assessing the organization capabilities. What are the organization's weakness, organization strength and weakness. Those are the main thing in the assessing organization. Assessing the future, right? In the future, are there any threats to the organization? Are there any potential this mean threat or opportunities? Are there any opportunities or threats in the future? And assess the expectations, right? What are the stakeholders, shareholders' expectation, whether they want to bring the company to the next level or they are going to diversify their company to the another sector. So those kind of expectations, all of things has to be considered, right? All of things has to be considered, and then they have to go forward the second step, that is the objective stage, right? Based on this assessment, they have to set the objective. Then the objective stage, they have to evaluate the corporate objectives. So they have listed out the objectives, objective 1, 2, 3, 4, right? That so they have list out the objective. So based on the environmental analysis, they may drop the existing objectives. They may include new objectives, right? Then they finalize this is the objective, right? This is the prime objective of the organization, right? They define the objective concretely. Concretely, they have to decide the objective. Then evaluation stage. Now that's number 3. Consider alternative ways of achieving the objective. Actually, these are the strategies. These are the strategies. How they are going to evaluate, how they are going to achieve. So they have decided the objective, is the objective of the company, and they have to find the alternative ways or way of strategy 1, strategy 2, 3, 4, 5, like that. Then they consider different right ways, strategies, consider alternative ways of achieving objective. That's number 3, evaluation stage. Number 4, corporate plan. Corporate plan, this is for entire organization, right? Entire organization. It is done at the CEO level, CEO or chairman level. They will do the things. This plan is for the entire organization, right? So they will decide in 10 years how the organization should be, right? Whether they are going to enhance the market share, they are going to introduce with the product, or they want to make the profit of this much. They want to enhance the company size to this stage, likewise, right? When we say it simply, then Elon Musk, right? Elon Musk always he telling the new strategies, objectives. So now recently he has announced that he's going to establish a new company. So that could be compete. That could be a direct competitor of Microsoft. Microsoft provide only software solution. They are providing operating system, and they are providing cloud services, and they are providing what you call softwares applications. But Elon Musk, now he is going to establish a new company that will provide software solution plus hardware solution, that will be direct competitor of Microsoft. So this is the what objective, right? Objective. Then there's a plan. So he may have plan, right? Once he submit the plan under his organization, so there are a lot of units: production unit, human resource planning unit, production planning unit. So there are units. So they will propose plan and strategies to achieve the corporate plan. So that is called what? The short-term planning. Short-term planning. So planning may be right in the corporate level for entire organization, and the plan for each and every division. Here, production department, they will propose one planning. So that plan should be aligned to achieve corporate plan. Resource planning, product planning, and research and development plan. So these are the short-term planning for the achievement of the corporate plan. So detailed operational plan which implement the corporate plan on a monthly basis or quarterly basis or annual basis. Operational plans include short-term budget, standards, and objectives. So we will study in the future, right? What are the budget, right? There are sales budget and product budget, cash budget, and master budget, like the short-term budget, and the standard. So what could be the standard? Say to achieve 10 billion worth company, like that, and they have some different objects, short-term objectives, right? So that is planning. Now second, so control means here they may set the target, achieve the target on this stage. Now here at this point, so they have to achieve this point. This point. Now when they look at the trend, they deviate from the objective. So this time the management has to make some interferences to control this deviation, and they have to bring back to this objective, toward the objective. So that is the main purpose of the control. So there are two stages in the control process. One is performance of the organization and corporate plan, right? So the performance of the organization is set out. The detailed operational plan is compared with the actual performance of the organization on a regular continuous basis. The company has already have a corporate plan, no? Corporate plan. And to achieve these corporate objectives, there are divisions. Actually, the divisions has to work thoroughly to achieve the objective. Sometimes the divisions objective, the divisions, the operation performance are not sufficient. That time they make some corrective actions toward the achievement of the organization goal. So that is the performance of the organization. Second one, corporate plan is reviewed. Sometimes the corporate plan may be having some problematic issues. So that time they may adjust the corporate plan. The corporate plan is reviewed in light of the comparison of made any changes in the parameters on which the plan was based. Right. When we do the planning, the new technology. Here, for example, some companies made plan in 2020s. Those times there's no AI. Nobody's talking about AI. Now there's a huge changes in the market. AI, cyber security. No, there are a lot of chances of introducing supercomputer, no, quantum computing. So now the plan made on 2020s, it's not valid enough to this context, current context, because this AI world, people are talking about quantum computing, people are talking about the metaverse, digital twins, edge computing. So there are a lot of different things. So that they have to make some adjustments in the corporate plan. So the first one is right, corporate plan is fixed. Then unit plans are corrected based on performance, the continuous improvement. But the corporate plan, here the problem itself in the corporate plan, so that they have to make some of the adjustments in their corporate plan. Vision, right? Our country having vision 2030, we have a lot of visions. But when we look at India, they have vision Viksit Bharat 2047. India become a developed country by 2047. It's 100 years in the independence, right? So India should be a developed country by 2047. So they have a plan, but we have, I don't know. The corporate plan is reviewed in the light of comparison made any changes in the parameters of which plan was based. New competitor, new common instruction may come on, common changes to assess whether the objective of the plan can be achieved. Sometime, we made corporate plan 2020, but this plan cannot be achievable because of the technological and government changes. In India, so they have introduced 50% tariff on the export. A lot of companies made corporate plan based on their previous tariff, or just 10% tariff in USA, but now 50% tariff. So it's very hard to achieve that objective. So that they have to make some of the adjustments on their plan. They have to find exporters other than USA. They have to find exporters in UK, Canada, New Zealand, Turkey, right? So something may happen. Now earlier, China and India, those two are the enemies. Now they are coming together and to face the challenge of Donald Trump, the tariff. The plan is made as necessary. The plan is modified. The plan is modified as necessary before any serious damages to the organization. Effective control is therefore not particular without planning. Planning without control is pointless, right? So you should have plan and control. Those two things work together, right? The management decision making, right? What is planning, what is control. For planning and controlling, you should have a precise, accurate, relevant, timely data information. for planning and controlling. Now decision making. When you make decision, when you make any decision, when you make a decision, when you make decision, when a decision become necessary, when you don't want to make decision.
When we have choices to
Yes,
choose.
exactly. Yes. When do we have alternatives? When we have choices, choice A, B, C. So we have to make decision. Either we have to choose A, B, or C. That time only we have to make choice. Say when I ask you to choose out of these three, one. So you have to think. When I show you, just select one of these. Then I have only one option, and you have no choice other than choosing this medium. Right. So companies make decision when there are alternatives, choices, because of scarcity. In economics, you might study this. Management is a decision taking. Management is a decision taking. Managers of all levels within the organization take decision. Right, even from the employee to CEO, they have to take decision. Decision making always involves a choice between alternatives. Choice between alternatives, and it's the role of management accountant to provide information so that management can reach the information decision. Right. The management accountant. Right. The management accountant always give the information to the management. Right. That's why management accountant become crucial. They are the people who manage the information system. Management accountant always give the information. So it is therefore vital that management accountant is understand of the decision making process so that he can supply appropriate type of information. So MIS, Management Information System, is handled by management accountants. Let's see the decision making process. Right. First, identify goals, objectives, or problem. First, we need before giving information, I want to get the objective or the problem. So for what decision I want data. So based on the requirement, based on the objective or the problem, I can supply the required data. First, we need to get step one, identify the goals, objective of the problem. Second step, identify alternative solutions, opportunities which might contribute toward the achievement of them. Right. Third stage, collect, analyze relevant data about each alternative. Right. You may have to achieve this objective or to solve the problem. You may have different alternatives. Right. To evaluate this each alternative, you need the data. Right. You need the data. Fourth step, make a choice. So this is the point where you have to make a decision. Make the choice decision, state the expected outcome, and check that the expected outcome is in keeping with overall goals. So you have to make sure that your expected outcome should be aligned with the corporate goals or objective or this objective here. Next, implement the decision. And sixth, obtain data. Now, after implement the decision, right? You have already have an objective. To achieve that objective, you collect data and you do the analysis and you choose the best option and you implement that plan. Again, you have to collect data. Whether your plan implementation goes in correct way, to make sure that your plan everything goes as you planned. If there is deviation, you have to make some corrective actions, right? So that's called control. Obtaining data about actual results and compare the actual result with the expected outcome. annual achievements, right? So this is the decision making process. It has two things. Decision making always having two things. Number one, planning stage. This is planning, and the controlling. Planning, decision making always, right? Decision making always come up with planning and control. For this always you need data, right? Always you need data. And so there are frameworks: strategic planning, management control, and operational planning. So strategic planning is done by, normally it is done by the top management, CEO, board of directors level. And the management control, management planning, it is done by at the director finance. Director finance will make decision on financial matters. And the manager, director marketing, he will decide on marketing aspect. He is not considered about HR or finance or IT, right? So he planned within his function. It's called management plan or functional plan. Operational plan, right, under the marketing. So there are some marketing manager for a product A. So the company is having many different products, say 5 product A, B, C, D, E, and one manager, say product A manager, he make plan for particular product A. So likewise, so that is called operational plan, operational controls. Strategic plan, management control, and operational control, right? So you can read it. Management control system, type of information, size information, technical information, operation information, right? Financial accounting and financial accounting, cost accounting, and management accounting, right? So in financial accounting, what are the output you can get? Have you studied financial accounting? At least basics? Have you studied financial accounting? At least basic level, at basic, not deep, basic level. Have you studied? So in financial accounting, what type of statement do you prepare? What statements you prepare in financial accounting?
Balance
Jihani,
sheet?
can you, balance sheet, yes,
I
balance sheet,
haven't
yes.
studied, sir.
Sorry? Yeah, I didn't hear. So
It's
what
a
do you
balance
prepare?
sheet, income
Balance
statement,
sheet, income statement, yes. What else?
cash flow.
Cash flow statement, yes, very good. What else? What else? So all of this, the objective of financial accounting, right, is to prepare balance sheet. Balance sheet shows what? The strength, how much assets it has, how much liabilities it has, how much short-term assets, how much long-term liabilities it has. It shows financial position, isn't it? Balance sheet shows you financial position of a company. It give you idea about financial strength or weakness of the company. That's called financial balance sheet. In the financial position or income statement, you can see whether company make profit or loss. Company make profit or loss. That the thing you can see at in the income statement or profit loss account. Cash flow statement, how company has generated cash or how company spend cash to assess the movement of the cash. So that's the purpose of preparing cash flow statement, right? These statements prepared based on the past data or predicted value. You know, the balance sheet. Balance sheet is prepared based on the past or actual data or expected or projected values.
From past data, right?
Yes, past data, right? Past data, right? Do we have any standard format for preparing balance sheet or income statement or cash flow or not?
Yes, we have.
Yes, we have. We have accounting standard. We have companies account, companies act. We have to publish if you are part of our PLC. If you are PLC, listed company, you have to publish their accounts, right? So it's a legal requirement. It has if you are not published this statement, you will be penalized. You may face some legal consequences. So that is financial accounting, right? Financial accounting, right? The cost accounting. What do you mean by cost accounting? Have you studied cost accounting earlier? What type of statement? What type of statement you prepared under cost accounting? What are the elements of cost to produce a product? What are the elements? What are the elements of cost? Major ingredients of product. For example, to produce a piece of cake. What are the elements? What are the costs included to produce a piece of cake? What type of cost it includes? Any idea?
All the ingredient cost.
Yes, ingredient cost. Yes, material. That's
Raw
called material, right?
Yeah,
Material cost.
material
Then
cost. Then the processing cost and other
material cost.
transportation.
Material cost. There are three, right? There are three. One is material cost. Number two, labor cost. Labor cost and other cost. Other cost mean say to keep the cake in a safe manner, right, in the fridge, or we have some of other cost, the cost other than material and labor. That's called overhead cost. So there are three elements of cost: material cost, labor cost, and other costs. So electricity, insurances, service charges, consultant fees, right, storage fees, storage charges. So what is the purpose of so what type? So there are three elements. No, there are three elements. Then what type of statement we prepare, right? Have you do you know that FIFO, LIFO? Have you heard about FIFO, LIFO?
Yes.
Yes. So what the purpose of preparing that one? FIFO, first in, first out, last in, first out. So what is that? For what purpose we use this?
To avoid the expiries and
Valuing inventory cost. Inventory cost, isn't it? Valuing interest cost. First in, first out, last in, first out. So factories issuing and receiving inventories. For that, they use this method. And you know, another cost here, reorder level, economic order quantity, and maximum stock level, minimum stock level, safety stock level. Have you studied these things? Have you studied pre-order level, economic order quantity, holding cost, and order cost? Have you studied this kind of things? Have you heard about this term? Inventory level management. Inventory. Is it new terms? Are these new terms to you? You see, you might see this kind of diagram like this. The diagram. Here, time and the level. So inventory, they place an order, right? They be consumed, right? And then this is reorder level. This is maximum stock level. This is minimum stock level, right? So now they have stocks at maximum level. Now when time passes, the inventory levels goes down. Once they reach the point, they order for inventory, and it takes time, right? And now the stock reaches at this point, and the already ordered, no, then the orders item reached at this point. So it continues like this. Don't you study this one? Inventory management. Inventory management. So EOQ. Don't you study this kind of equations? Don't you study it? So that is about here element of cost. Element of cost, number one, inventory cost. Inventory cost. Number two, labor cost. Number three, other cost. So you may study it here, inventory, cost, inventory costing, inventory level management, inventory level, where you can study what maximum stock level, how much maximum stock we have to have, and what's the minimum stock level, what is the ROL, reorder level, and economic order quantity, right? And the inventory pricing, FIFO, LIFO, weighted average method, right? You might study this kind of techniques. So this is for what the purpose, right? So inventory cost. So this is it's a cost, labor cost. Say the labor cost, how much has to pay labor cost or labor cost per hour, and labor cost it has to pay overtime, and has to pay some sort of incentives, labor incentives. Under incentive, you might study Halsey, Halsivia, 401, and you may study the payroll. Payrolls mean what? Salary to the employees. So those kind of statements you might study. And other cost may include what? Electricity cost, and rent cost, rent, and management cost, all of these things. So always these are talking about cost. So this is what cost accounting. This is called cost accounting. So the purpose of cost accounting is what? To ensure the cost and cost control. So that is the purpose of cost accounting, right? Do companies publishes cost accounting statements? Do companies publishes cost accounting statements publicly?
No, sir.
No, it's an internal purpose, no? So they prepare for internal purpose. So you know what is financial accounting and cost accounting. Next one is management accounting. Management accounting. So under the management accounting, you might study break-even analysis, break-even point. Break-even point. Simply we call BEP. Break-even point. And budget. Under the budget, there are many things. Say sales budget, production budget, purchase budget, labor budget, and master budget, cash budget, right? And standard costing and variance. Standard and variance analysis, and short-term decision making. So those accounts coming under management accounting, right? Here, so there's a relationship. That's a relation. Financial accounting, cost accounting, and management accounting. The finance accounting always they are dealing with the past data, right? Past data. And cost accounting always they are focusing on current data. And management accounting is always future. So decision making, cost accounting and management accounting are used. So the cost accounting uses current data and management accounting uses future data predictions. The budget, break-even point, all these things coming under cost accounting, management accounting. That's why financial accounting is taught separately, and cost accounting and management accountings are taught together, right? Or because these two things works together, right? So I will upload the book. I will upload this book, right? So financial accounting, what is financial accounting? What is management accounting? I will upload this PDF book on the VLE project in the LMS, so that you can read it. And the next class I will give some more introduction about that. And the next class we will do some calculations, right? So that I will plan accordingly. This is the first class, so I want to get your the level of knowledge in accounting, so that I can plan accordingly the future sessions. So do you have any doubt, any questions? Do you have any WhatsApp group?
Yes,
Do
we
you have
have.
any WhatsApp groups? So create a WhatsApp group so that we can share materials and we can discuss class arrangements and informal communications. among the group regarding subject matter. So please note this number
Sir,
and create a WhatsApp.
Already we have
Okay.
one.
we do have
Okay.
a WhatsApp group already.
Okay. Please add me. This is my number. Please add me this number. We can share some of the materials, and you can place your questions on that group. Any questions? Any questions? Right. If we have no questions, we can wind up the class. If you have any doubt, feel free to contact me via WhatsApp. Anything else? Anything else? Discuss. Okay. Thank you very much. Some of you are getting boring. Some of you are getting active. But because of the net, yes.
You said MIC and CRM. CRM is
What is that?
MIC is okay. CRM.
Yeah, yeah. Customer relationship management.
All right. Okay. Thank you.
Okay. Okay. Anything else? Okay, we'll meet by next week. Holiday, no? No classes. Am I right?
We weren't informed anything about that.
So when we look at the sheet, the timetable, so next week could be holiday, I think. Next class will be on academic calendar. Seven. I think holiday, I think. Okay, they will update you. So it may be temporary. Okay, let's start by next class. Thank you. Good night.
Thank you,
you,
Mr.
sir.
Riyath.
Thank you, sir.
Thank you.